Hey everyone. So Trump's One Big Beautiful Bill Act has passed, and 2025 taxes are fast approaching, and there's been a lot of changes to 2025 and 2026. There's also introducing new rules, so I figured I'd make a video discussing most of them. I'm not going to cover every single item because we'd be here all day, and that's not the point. Anyway, there's going to be timestamps below, so you could just skip around to what you want to know. First up, I'm just going to talk about all the existing rules on all the adjustments that are happening to them. Just to get them out of the way quickly, I'm just going to blaze right through it, and then we're going to focus on all the new rules. All right, first up, standard deduction. Standard deduction is actually increasing again. Normally, standard deduction is always increasing year over year, and it's just being adjusted to inflation. But this time, the One Big Beautiful Bill Act has increased it one more time. Basically, the numbers are going up again by about 750 to 1,500, depending on your filing status. As for 2026, the standard deduction is going up by a moderate and normal amount as indexed to inflation, so it's going up by about $350 to $700 again, depending on your filing status. Next up is going to be the child tax credit. The child tax credit is actually increasing for 2025, so it used to be $2,000, and now it's going to be $2,200. Not only that, but it's actually going to be indexed to inflation. So what that means is that it's going to increase year over year beginning in 2026, which is amazing news because normally the child tax credit is just flat, and it's been flat ever since it was established. Of course, it has like random adjustments. So I believe the last change was in 2017, I believe, where it was increased to $2,000, and it's been at that $2,000 forever, really, until now, where it's going up to 2,200, and then it's going to be going up again in 2026 and again in 2027, so that's great news. Now, continuing with the child tax credit, there's something called the additional child tax credit, and it has to deal with the refundable portion of the child tax credit. Now, the amount is not changing. It's still going to be $1,700, but what it did say was they're going to make it permanent. Now, permanent doesn't actually mean permanent in the tax world. All permanent means is that when a president says, oh, this change is going to be permanent, that means it's going to stay that way until the next president or Congress decides, hey, we want to make a change, and then that new change is going to go into effect and it's no longer permanent. Next up is a child and dependent care tax credit, which is a credit for people who have children and they have expenses for like daycare and stuff. So the expense amount is not changing. That's still going to be $3,000 for one child or $6,000 for two children. However, the maximum credit is increasing. So the maximum credit is going to be 50% now instead of the 35%. And all these new rules are going into effect in 2026. Also, the AGI is going up a bunch. It's pretty much more than double, which is fantastic news. Basically, what that means is that when you're filing for this credit, the chances of you getting more money back is higher because of those AGI thresholds going up so much. All right, next up, let's look at some retirement planning stuff. So employee contribution plans, so your 401k, 403bs, and so on, they're going up from 2025 to 2026 by $1,000. And the catch-up contribution is also going up by $500. So the catch-up contribution is for those people who are age 50 or older. As for the super catch-up contribution, which is for those people who are age 60 to 63, that's staying exactly the same. That's going to be $11,250. However, the maximum that you're allowed to contribute into your 401k or 403b plans and so on is going up as well. So in 2025, it was $70,000, but now it's going up to $72,000. As for the IRAs, the maximum contribution is increasing by $500. So in 2025, it was $7,000, and in 2026, it's going to be $7,500, and the catch-up is going up by $100. HSAs, or health spending accounts, they're also going up for 2026. So if you have the self coverage, essentially, it's going up by $100, and if you have the family coverage, it's going by $200. However, the HSA is introducing two new rules. So the first rule has to deal with health insurance. If you're one of those people who get their health insurance through the marketplace, whether it's the federal marketplace or the state marketplace, doesn't matter. There are going to be two plans in there, which is the bronze plan and the catastrophic plan. So if you have one of those plans, then you are going to be eligible to contribute into your HSA, regardless of what their deductibles are. As for the second rule, it's going to be addressing something called the direct primary care service arrangements. And those arrangements are basically very, very niche, and I'm not going to be covering them, but basically know that if you have one of these arrangements, then they're no longer going to be treated as health insurance plans. And if you have them, you could still contribute towards your HSA. However, you need to keep a monthly limit, and your monthly limit depends on your arrangement. So if you have an individual arrangement, then your monthly limit is going to be $150 a month or lower. And if you have like a family arrangement or a group arrangement, then your monthly limit is going to be at $300 or lower. And those amounts, the limits for like the $150 and the $300 a month, are going to be indexed to inflation, I believe, starting in 2027. I believe so, yeah. Oh, just wanted to note that the HSA catch-up contributions are not increasing. They're still staying the same at $1,000, but the only difference between the HSA catch-up contributions and the ones that we discussed earlier, which was the retirement plan stuff, is that the HSA catch-up contributions begin at age 55 or older. All right, let's move on to itemized deductions, and I'm just going to go in order because there's a bunch of changes to these itemized deductions, and the way they appear on the form is the way that I'm going to go. So first up is going to be state and local taxes. State and local taxes, the limit was $10,000, which was set back in 2017 due to the Tax Cuts and Jobs Act. But now that limit is going up in 2025 to $40,000. Now that $40,000 is actually for everybody except those who are married filing separate, who are only allowed up to $20,000 in deductions. On top of that, the limit is actually going to be increasing every single year by 1% beginning in 2026. So 2025 was 40,000, 2026 is going to be 40,400, 2027 is going to be 40,804, and so on. You get the picture. Not only that, but that state limit is actually going to be phasing out slowly over time depending on your income. So if you're making a certain number of money, you're going to get less of that 40,000. However, it's not going to go below the $10,000 mark. Next for the itemized deductions is going to be the mortgage insurance premiums. So this thing is actually back. So back in, I think 2021 or 2020 was the last time you were eligible to get that as a deduction on your itemized deductions. And now it's back for 2026. So 2025 still can't do it. 2026 you can, and that's great news. The next item is going to be casualty and theft loss. And technically this is very, very niche, and I didn't even want to cover it, but the change is, in my opinion, is so massive that I figured I'll just quickly mention it. So normally casualty and theft losses, you're allowed to take them if it's due to a federally declared disaster area. However, beginning in 2026, it'll be the federally declared disaster areas and state declared disaster areas. So I feel like that state adjustment or addition to that is going to make a pretty big change, and more people might claim this deduction. And finally, there are changes to charitable contributions, but I'm going to leave that for the new part because there are so many nuances and so many little things that have changed, and it was significant enough just to put it into the new section. So I'm going to discuss charitable contributions a bit later. Student tax credits are not changing, but the requirement is changing. So before, you were allowed to take the student tax credit if you had a social security number or an ITIN. But now, if you have an ITIN, you can no longer take the student tax credit. And this is beginning in 2026. Staying in line, talking about students and school expenses, let's talk about 529 plans. Now, 529 plans have been expanding a lot. So initially, 529 plans were only for college expenses. Now they're for K through 12 and college expenses. And now they're being expanded even more. So now 529 plans will be including things like K through 12, college, elementary schools, private schools, religious schools, and even homeschooling. On top of that, they decided to add credentialing. So what credentialing is that if you're like an accountant, a lawyer, a doctor, you have to take exams, and those exams cost money. So those exams like the bar exam, the CPA exam, your medical exams that you have to pay for, you could actually use your 529 plan and pay for them. On top of that, most of these professions also require continuing education. And if you're paying for continuing education, you could use your 529 plan to pay for that as well. But this is not only limited for like these three professions. There are certain certificates out there that you could get for like becoming an electrician or a plumber and so on. Like 529 plans could also be used for that. And all of these new changes to the 529 plans are actually beginning now. So for 2025, they went into effect on July 4th, 2025. Finally, the last thing that we're going to discuss in terms of like the old stuff is going to be qualified business income deductions. Now, this is a very technical and complicated topic, so I'm not going to discuss all the nitty-gritty things for it. All you need to know is that if you're self-employed or you have a partnership or an S-corp, then this deduction is not going anywhere. This deduction was set to expire at the end of 2025, but it's been extended and made permanent. And we already discussed what permanent means. All you need to know that if you're self-employed, if you have a partnership or an S-Corp, this deduction that gives you a 20% deduction on your income is not going anywhere. And that's fantastic news. Better yet, it's actually being expanded a bit. All right, we finally got rid of the old stuff. Let's look at the new stuff. First things first, there's going to be a brand new form. It's called Schedule 1A. And that form is going to cover all the new deductions. Your deduction on tips, your deduction on overtime, your deduction on the new car loan interest, and the new senior deduction as well. And something that you want to know is that all these new deductions begin in 2025 and are set to expire after 2028. As for the deduction on tips and the deduction on overtime and then the new senior deduction, they actually share two requirements. So the first requirement is that you must have a social security number. And the second requirement is that if you're married, you must file as married filing joint. So if you file as married filing separate, you cannot get these deductions. And last thing that I want to point out is that for deduction on tips and deduction on overtime, a lot of people are thinking that you are not going to be paying taxes at all on these amounts. And that's just not true. What I mean by that is these deductions are limiting how much you're paying in terms of federal tax obligations. However, the tips and the overtime is still going to be subject to FICA, and FICA is your Social Security tax and your Medicare tax. All right, so let's start with the deduction on tips. The maximum deduction on tips that you'll get is $25,000, and it's only on qualified tips. And qualified tips has two main requirements. So the first requirement is that when they're paid, they must be paid voluntarily by the customer. So if you go to a restaurant and the restaurant gives you a receipt and it automatically includes, let's say, like a 15% tip that you have to pay, it's no longer a tip, it's actually a service fee, and those are eliminated right away. They're not counted as qualified tips. The second requirement is that the qualified tips only belong to industries that customarily get it, as well as occupations that customarily get it. So in the past, that used to be only beverage and food service industries. However, they have been expanded a lot, and there's 8 new categories. Some include like transportation, delivery, entertainment services, and so on. There's a bunch of them. Not only that, these 8 new categories actually have subcategories, and the subcategories are extremely important, and you'll see why later when I go through examples. But the subcategories are the ones that give you a treasury code, and that treasury code is something that you'll need in order to get the deduction. Another requirement for the deduction on tips is that if you're self-employed, your deduction is actually going to be limited to your business income. Before I show you some examples of how the deduction on tips even works, I wanted to mention something. So earlier the IRS mentioned that they're going to be treating 2025 as a transition year. And what that means is that they're not going to hold employers responsible in providing you with the necessary information in order to get the deduction for tips or the deduction for overtime. So what that means is that you're going to need to get the necessary information yourself. And the necessary information for tips is that your total qualified tips that you receive for the year and your occupation code, or earlier I called it as a treasury code. It's the same thing. So how can you get this information? Well, it's not that as bad as it seems. Some employers are actually just going to provide it themselves. For some, you could just ask your employer if they're not providing it to give you that information, and I'm pretty sure most of them will just give it to you. Otherwise, if they're not giving you anything, then one of the things that you could do is look at your W-2 if you're getting qualified tips, and look at box 7. There's something called Social Security tips. If you have a number there, then you could use that amount as your qualified tips for the year. If you don't have anything there, then some industries actually fill out a form called 4070. So employees fill this form out and they give it to their employer every single month. And it basically says, as an employee, hey, this is how much tips I received for this month. Please record it somewhere. So if you have copies of those forms, you could use them to calculate your qualified tips for the year. And if you didn't keep copies, that's fine. Just go to your employer and ask for some copies. All right, let's look at some examples for deductions on tips. Example 1, we're going to keep it very simple. So we have Peter, and we're going to assume he's a restaurant server, and he gets a W-2. And on his W-2, he has an amount in box 7, which is Social Security tips, in the amount of $7,000. Now, Peter has no other tips being reported anywhere else. So for us to figure out his tip deduction, we need to know 2 things. The first thing is total qualified tips, and the second one will be his occupation code. For his total qualified tips, we already know that amount, and that was given to us on his W-2 box 7. So we're just going to use that, and that was $7,000. As for his occupation code, the way that's going to work is we're going to go to this IRS website, which I'll provide a link for you guys in the description below, and we need to figure out Peter's industry. Now, since Peter works in a restaurant, his industry is going to be the beverage and food service industry. Now, after we figured out his industry, we need to know his actual job in that industry. And since he's a server, we're going to assume that he's waitstaff, and according to the IRS, his code is 102. So now that we have everything that we need to figure out his tip deduction will be in the amount of $7,000. Example 2 is going to be a bit trickier. So we have Lois, and she's a bartender, and she reported in 2025 $10,000 in tips to her employer via Form 4070. She also gets a W-2, and her W-2 also has an amount in box 7 of $7,000. Now, for Lois, all the requirements are exactly the same, but we still need to know the total qualified tips, and we still need to know her occupation code. So for her total qualified tips, the problem is that she has 2 places that are reporting 2 different tip amounts. So what does she do? Well, she could actually use whichever amount she wants. She could either use the amount from the W-2 of $7,000, or she could use the amount of $10,000 from all her Form 4070s that she provided to her employer. However, she cannot combine them. So it's either one or the other. If I were her, I would use the Form 4070 amount of $10,000 because she will get a bigger deduction. As for her occupation code, it's going to be exactly the same procedure. So we're going to go back to that IRS website. Her industry is going to be the beverage and food service industry. And since she's a bartender, her code is going to be 101. So her tip deduction allowed that she's allowed to take is going to be $10,000. For the final example, we have Brian, and let's assume he is self-employed and he's a barber and he has his own salon. His sales are $100,000 and his net profit is $70,000. Now, let's also assume that out of that $100,000, $20,000 is in tips. Now, he uses a platform called Square, so he could actually justify all his tips because let's say Square gives him a statement that breaks out everything. Now, all the requirements are exactly the same. We still need to know the total qualified tips and we still need to know the occupation code. So his total qualified tips will be $20,000 since he could justify it. As for his occupation code, we're going to go back to the IRS website. We're going to find his industry, which will be the personal appearance and wellness industry. And since he's a barber, his code is going to be 603. Now his tip deduction allowed is going to be $20,000. I'm going to take it a step further because some people might be curious, and I will figure out his qualified business income deduction QBID. So this is actually going to be calculated after figuring out his tip deduction. So his QBID is going to be $10,000. So that brings his taxable income to only $40,000. On the flip side, what if Brian's net profits is not $70,000 but is actually only $15,000? Well, his tip deduction allowed would only be $15,000 as well, even though he got $20,000 in tips. The reason for that is because when you're self-employed, your tip deduction is limited to your net profits. So his net profit is only $15,000. Taking it a step further, his qualified business income deduction is going to be 0. And that's because his tip deduction is eliminating all of his net profits, so there's just nothing left. So that brings down his taxable income to $0 as well. Now, technically, Brian is not going to be paying $0 in tax because that $15,000 in net profits is still subject to FICA taxes. Now let's look at the deduction for overtime. Some additional requirements is that it only applies to qualified overtime, and qualified overtime is basically pay that you get that is in excess of your regular hourly rate. On top of that, you cannot be an employee who's in an executive capacity. So what that means is that if you're a person who's actively managing the business, then you cannot get this deduction. On top of that, if you're a person who owns at least 20% of the business, you also cannot get this deduction. The final requirement that I'm going to mention for overtime is that any excess pay beyond the time and a half that you get for your rate is going to be disallowed. And we'll take a look at this better in an example a bit later on. Of course, there are other requirements that exist for overtime deduction that I'm just not going to cover because they're too niche and it only applies to a very handful of people. For example, there's something called exempt employees, and they have a whole different set of requirements, and mostly they are not allowed this deduction, but if they meet those requirements, then they could get this deduction. Otherwise, just ignore it. As I mentioned earlier, for the deduction of tips, but the IRS is going to be treating 2025 as a transition year. So what that means is that the employer is not responsible for giving you the necessary information. So for overtime, it's the same thing. So you're not going to get your total overtime on your W-2 and all the necessary bits in order to get this deduction. However, keep in mind that it's only for 2025. So 2026 and on is actually going to be absolutely fine because the W-2 is going to record everything. It's going to give you your occupation code. It's going to give you your qualified tips amounts. It's going to give you your qualified overtime amounts and so on for 2026. But 2025 is the only problem year. So for overtime, just like for tips, what I'm going to suggest is that you just ask your employer for the information, Or if they don't give you that information, you could simply log in into your payroll or whatever software that your employer uses and get the pay stubs. The majority of the time, pay stubs will break down everything in terms of hours and your pay rate. So it should list out what your overtime hours were, what your pay rate for your overtime is, and the total overtime pay that you received. All right, let's look at some examples for deduction of overtime in order to see how it works. Example 1, we're just going to keep it simple. So we have Peter again, and he works somewhere. It genuinely doesn't matter where the person works, as long as the person meets all the other overtime requirements that we have discussed. So for Peter, what do we know? We know his base rate is $20 an hour, his overtime rate is $30 an hour, or time and a half, and his total overtime hours worked is 500 hours. And in order to figure out his overtime deduction, we need to know his overtime premium rate, which is $10 an hour. Now, there's a bunch of ways to figure out that calculation, but my preferred approach is just to take your base rate and divide it by 2. So in order to figure out his total qualified overtime amount, that would take his premium rate and multiply it by his overtime hours worked, which is 500 hours, which gives him $5,000. So his overtime deduction that is allowed is going to be $5,000. For example 2, we have Lois. Now, Lois' situation, we're going to keep it exactly the same as Peter's, except for overtime rate. So for her overtime rate, she's getting paid double her base rate, so she's getting $40 an hour. So what does this change? It actually doesn't change anything. So technically, her premium rate should be $20, but it isn't. It's going to be exactly the same as Peter's at $10 an hour because according to the Fair Labor Standards Act, everything that is beyond a time and a half is disallowed for the overtime deduction. So that's why Lois is getting the same exact overtime deduction of $5,000 as Peter. But what happens if we change Lois' situation up just a bit? So let's say instead of her total overtime hours worked of being 500 hours, let's change that to 1,500 and let's add a filing status of married filing joint. What does that do? Well, her overtime premium rate, that won't change, but her total qualified overtime is going to go up to $15,000 because her total overtime hours worked has been increased to 1,500 hours. So that makes her overtime deduction allowed $15,000 as well. But let's change her situation up one more time. So instead of being married, let's just say she's single. What happens? Well, besides making Quagmire really happy and getting his shot at her, her situation is actually not going to change. Everything is going to stay the same except overtime deduction allowed will be decreased to $12,500 because that is the cap for everybody except for those who are married filing joint. For the final example, we've got Stewie. And let's just say Stewie has his own company where he owns 100% of that company. And he has 2 employees. He's got Brian and he's got Chris. And we're going to also assume that all of them worked overtime. So Stewie worked 500 hours of overtime, Brian and Chris both worked 750 hours of overtime. So what happens? Well, Stewie is automatically disallowed to get overtime deduction, and that's for 2 reasons. The first reason is because he's going to be considered an employee at an executive capacity because it's his company. And the second reason is because if he has at least 20% ownership of the company where he works, he is fully disallowed from this deduction as well, and he has 100% ownership. As for Brian and Chris, they're absolutely fine. They're allowed to get the overtime deduction. And for them to figure that amount out, they will have to do the same calculations as Lois and Peter did for their examples. Sorry, quick interruption because I noticed while I was editing that I did not mention anything about tips and overtime for states specifically. Now, technically that was on purpose. So I made a table where you could find your state and just see what applies to you. However, huge disclaimer, a lot of this information I haven't updated since mid-January of 2026, and I have no idea when this video is actually going to come out. So just be aware that some of this information might be outdated. Also, you'll see some states have a number next to them. If you find your state and your state has a number next to it, just read the information a bit more below. But basically what that means is that that state has some kind of additional rule or certain caveats. For example, if you look at Colorado, Colorado actually appears in 2 columns. And if you read number 2, it will tell you why that is. Also, you'll notice that there's a bunch of unknown states. Now, technically, that is just the nature of tax law. However, if your state is still unknown to this day, your best bet will be to assume that that state just does not allow deductions for tips and overtime. Moving on to the deduction on the car loan interest, and before we get into the details, I wanted to mention something, and that this deduction could be taken by anybody, unlike the mortgage interest, which is only allowed by those people who itemize deductions. So let's look at some additional requirements. The additional requirements include things like the car cannot be a lease financing, the loan must be originated in 2024, and the maximum deduction that you could get is $10,000. You must be the original owner of the car. So if you're getting a loan for a used car, this will not work. And the final assembly of the car must be in the United States. And the way they're going to justify that is that they're requiring the VIN number be part of the deduction. So in order to get the deduction, you must provide the VIN number to your accountant or on the form. And as we mentioned earlier, is that 2025 is going to be a transition year. So you're not going to know what your interest amount that you paid on your car loan is. So let's say it actually does apply to you for 2025. What you could do is go to your loan provider and ask them for that information. And every year after 2025, you'll receive a form called 1098 VLI, which stands for Vehicle Loan Interest. And finally, we're up to the last new deduction, which is the senior deduction, which applies to those people who are age 65 or older, and the maximum amount that you'll get is $6,000 of deduction. Keep in mind that this deduction is in addition to your standard deduction or your itemized deduction, so it doesn't matter which of those you take. If you're a senior, you will get this deduction as long as it's not completely phased out. Also, something to note that this deduction is not going to be indexed to inflation. It's not going to increase at all. So in 2025 until the end of 2028, it is going to be the flat $6,000 limit. As promised, let's talk about charitable contributions and all the changes for them. So for those who take the standard deduction, you're actually allowed to take the charitable contribution deduction again. And this is something that was allowed back in 2021. And I think the limit was $300, I believe. And now the limit is going to be $2,000 if you're married filing joint. And for everybody else, it's going to be $1,000. However, there are some requirements that need to be met in order to get this charitable contribution deduction as a standard deduction filer. And the first requirement is that you cannot donate to a donor advised fund. And a donor advised fund is basically just a fancy word for an account where you could donate your money, and normally that money will automatically count towards a charitable contribution, even though that money has not left that account to go to the charity. The next requirement is that you cannot donate to a non-operating foundation. So what that means is that when you're donating funds to a non-operating foundation, it's basically like a middleman where it takes in all the donations and then it'll displace them or just disperse them to various charities on your behalf. So that is not allowed. It won't be counting towards your deduction for your charitable contributions. And the reason it's not allowed is because these non-operating foundations don't actually provide a public program on their own. The people who take the itemized deduction, the charitable contribution changes for you is that now there's going to be a 0.5% floor. So what that means is that, let's say your AGI is at $200,000. In order for you to get a benefit from your charitable contribution, you'll need to donate more than $1,000 because that $1,000 is the floor that is going to be disallowed. So everything over that floor will be considered as a charitable contribution deduction that you'll be allowed. One last thing that I want to mention is that there was an executive order that was passed and it's mentioning all federal agencies. And the reason this is important is because the IRS is included. And basically what that executive order is saying is that it wants all federal agencies to stop issuing paper checks by September 30th of 2025. And the reason this is important is because if you're one of those taxpayers who gets their refund via a paper check and prefers it that way, then you will no longer be able to do that unless you file for an exemption. All right, those were all the new adjustments and changes for 2025 and 2026. I hope this video was helpful. My name is Eugene, just some random tax guy on the internet. I'll see you later.